Welcome back to our channel, Proactive Thoughts. Today, we'll be discussing two popular trading strategies in the crypto world, spot trading and futures trading. We'll also explore the concept of leverage and delve into the advantages and disadvantages of each method. So let's get started. Hello, fellow crypto enthusiasts. I'm your host, Mohammed Asif Bashir, and in this video, we'll be taking a deep dive into spot trading and futures trading in the cryptocurrency market. Let's start with spot trading. Spot trading involves buying or selling cryptocurrencies for immediate delivery. It's a straightforward method where traders directly purchase digital assets at the current market price. Spot trading takes place on spot exchanges, which provide a platform for traders to buy or sell cryptocurrencies instantly. Spot trading offers several advantages. First, it provides quick access to the cryptocurrency market, allowing you to buy or sell assets at the prevailing market price. Second, spot trading eliminates the complexities associated with futures contracts and expiration dates. It offers simplicity and ease of use, making it suitable for beginners. Additionally, spot trading allows for direct ownership of the underlying asset, which means you can transfer or use the cryptocurrency as you wish. However, spot trading does come with a few disadvantages. One major drawback is the lack of leverage. When spot trading, you can only trade with the funds available in your account. This means your potential profits are limited to the capital you have invested. Additionally, spot trading doesn't provide an opportunity to profit from declining prices, as you can only benefit from price increases. Now, let's move on to futures trading in the cryptocurrency market. Futures trading involves buying or selling contracts that obligate traders to purchase or sell cryptocurrencies at a predetermined price and date in the future. Unlike spot trading, futures trading allows traders to speculate on the future price movements of cryptocurrencies without owning the underlying assets. Futures trading offers several advantages. First, it provides the opportunity to profit from both rising and falling markets. Traders can take long positions to profit from price increases or short positions to profit from price decreases. Second, futures trading allows traders to utilize leverage, which means they can control a larger position with a smaller amount of capital. This potential for increased profits attracts many traders to futures markets. However, futures trading also has its disadvantages. The use of leverage can magnify both profits and losses, making it a high-risk strategy. If the market moves against your position, you could face substantial losses. Furthermore, futures trading requires a deeper understanding of market dynamics, including factors that affect prices and expiration dates. It may not be suitable for beginners or those unfamiliar with trading concepts. Now, let's briefly touch upon the concept of leverage. Leverage in trading refers to the ability to control a larger position in the market with a smaller amount of capital. It allows traders to amplify their potential profits but also increases the risk involved. For example, if you have a leverage ratio of 10-to-1, it means that for every $1 of capital you invest, you can control $10 worth of assets. While leverage can enhance profitability in favorable market conditions, it's crucial to remember that it also amplifies losses if the market moves against you. It's important to exercise caution and have a risk management strategy in place when using leverage. To summarize, spot trading offers simplicity, direct ownership of assets, and immediate access to the market. However, it lacks the ability to profit from declining prices and the potential for leveraging positions. On the other hand, futures trading allows traders to profit from both rising and falling markets, offers leverage for increased potential profits, but carries higher risks and requires a deeper understanding of market dynamics. Ultimately, the choice between spot trading and futures trading depends on your trading goals, risk tolerance, and experience level. It's crucial to thoroughly educate yourself about each strategy and practice responsible trading to maximize your chances of success in the crypto market. That wraps up our discussion on spot trading, futures trading, and leverage in the cryptocurrency market. I hope you found this video informative and gained a better understanding of these trading strategies. If you have any questions or would like to share your experiences, please leave a comment below. Don't forget to like this video and subscribe to our channel for more insightful content on cryptocurrencies. Until next time, happy trading. Thank you for watching, and remember to stay informed and make wise trading decisions. See you in the next video.